and I'm the Junior Project Manager, Performance and Investment at GOGLA. And I'm happy to see all of you here today. We recently started this project on corporate governance as we think it's an important topic to focus on. And there are some substantial benefits for companies to have adequate corporate governance structures and practices in place. But we see that sometimes this has been challenging in the sector, and there's sometimes a lack of the tools and knowledge to do so, to improve these structures. Therefore, we are really happy to have Nestor Advisors on board today, a corporate governance consultant with many years of experience. That will host a training today, a core corporate governance training with a follow-up next week. As well, I'd like to thank FMO for making this possible. And I hope you will enjoy the session today. Without further ado, I think I will just give it over to David. Thank you.
Thank you, Puk, and good afternoon to you all. I guess there's no one on the other side of the Atlantic, well, again, I think I'm really looking forward for having this session when GOGLA mentioned that project, and I was in a sense very happy to simply because we've been working with a number of growing companies and some indeed in the sector as well of grid energy, and what we've seen is that sometimes the earlier the company addresses governance, the easier it is to structure its growth, to then actually to attract investors as well, and build trust, and the reason why many companies do not necessarily adapt and adjust to the governance practices, and I really insist here on the term adjust. We'll see that it's an evolution. It's simply because the founders have obviously many other things to take care rather than really taking care of governance, and it's a lack of awareness rather than a lack of goodwill in many instances. So that's I find a great opportunity to have further impact on the companies and support GOGLA. I'm the managing director of Nestor Advisors. We've been a firm specialized in governance based in London and working now for the last 20 years. We've recently merged with another governance expert firm that is focused on the institutional shareholder expectations, called Moro Sodali. So in a sense, we are kind of covering now the scope from what a fund like BlackRock and fund managers like BlackRock or Vanguard are expecting on governance side and in advising companies listed on a variety of stock exchanges, to the internal governance aspect of what Nestor Advisors was used to do and continue to do, which is really focusing on the companies that are from startups, SMEs, family businesses, up to companies that are backed by private equities, financial institutions, and others in Africa, in Asia, Europe, and Latin America, essentially, and working with the management, the board as well, in order to simply enhance the mechanism of decision making and control, and building trust around the business and its resilience. So that's what we've been doing. We've been doing that with a number of DFIs and impact investors from DFIs such as FMO, and I really thank FMO for that as well, together with GOGLA, and other impact investors that do want to not only provide finance but help the business achieving impact. And I think this session here, and what is core at Nestor Advisors, part of our philosophy is indeed help companies to have an impact. And in that sense, we are delighted to be part of that program. Together with me, Patrick, if you want, maybe to move. Yeah, there are a few slides that introduce ourselves, but we can make the introduction right now. Patrick, you with us. We prepare that.
Thanks, David. Good afternoon, everyone. My name is Patrick McNamara. I'm an associate here with Nestor Advisors. I've been working here for now just over 2 years, having joined after the completion of my master's studies in the States. And since joining Nestor Advisors, I've participated mostly working with financial institutions, central banks, microfinance institutions, including in Africa, and more recently working with David on training such as this one, delivered to direct finance institutions or other financial institutions and banks. So looking forward to today's session, as well as the one next week. And I think hopefully you'll find this enjoyable and valuable for your businesses, because that's the main purpose of today's session, to show the value and the importance of governance. David, do you want to go over the agenda?
Yeah, sure, with pleasure. So a brief introduction, and having you as well introduce yourselves. I think we are not as many as initially signed in, progressively getting now to close to half. But having you introducing yourselves, so we'll have the time. But after that, we'll be introducing governance, what it is about. I mean, we'll see that governance exists regardless in many instances. You just think of good governance, and introducing why governance and the value. And we just want to show you how both entrepreneurs, managers, and shareholders do value governance. And then we'll be focusing most of our time on the governance of growth and early stage companies like yours, and providing you will see that there is not one governance fits all, but that there are different stages. And with each stage of the company, there are different kind of governance practices that can and are expected. And here we have built this this afternoon around the main, I would say, expectations that investors such as FMO and the development finance institutions are looking at, and so that you are aware of. Maybe that's where you are today, but try to work towards the direction in order to meet expectations when you will need further finance, simply because we'll see that is what investors do expect, and they do expect that because that enhance the resilience of the company. So we'll be spending the hour going through that, having a lot of discussions. You'll see that we are not here to give a class only, but essentially to interact with you, to raise some questions, and we'll have a number of surveys all the afternoon together that will be running, and that will serve the basis of the discussion. And for these who are not on vacation, or for these who are on vacation but still want to practice that, we'll have next week, as Patrick mentioned, really have a case of a company in your sector and apply actually the kind of the framework to understand what are the different challenges and reforms that the governance could be made to enhance that. With that, let's move on. Patrick, I'll leave it to you to discuss the interactiveness.
Sure, thanks, David. So for both today's session and the session next week, we'll be using Zoom, the same link that you used to join today's session. You can also use to join next week's session. There are just a few elements of interactivity we like to highlight at the start of the session to kind of help you engage with the session and involve yourselves as much as possible. Firstly, we ask, and I think you've all already done this, that you mute yourselves if possible until asked to speak or invited to speak, just because this will get rid of any background noise or interference. If possible, we would love if you could keep your video on, mostly for us, so we're not speaking into a black void. But we understand as well that over a 2-hour session, you may want to turn it off and have a break for a period. And I can see a few coming back on. Thank you. That's great. And particularly when you're in the breakout rooms with one another next week as well, having your video on when you're chatting amongst yourselves will help the discussion, I think. At the same time, if during the session aside from the polling questions we're going to be asking you during the session, if you have any questions, any comments, anything that maybe hasn't been too clear or something you'd really like us to focus on and go into more depth on, you can either post in the chat as a written question and we can try and respond to that, or if you'd like to ask the question directly, kind of speak to us, you can raise your hand and then we can both invite you to speak and unmute you so that you can be heard by everyone. And please, at any time throughout the session, if you have a question, if something isn't clear, please do let us know. And regarding interactivity, I can see that you will also have polls that will be launching through Zoom during this training. And I can see David's giving an example of how to use the chat there. And yes, so please, any questions, all questions, we welcome your engagement as much as possible. We've already introduced ourselves briefly, so I don't think we need to stay on this for any longer. But this gives us our background, and we'll share the slide deck after the session, so you can see our full biographies if you wish. And maybe I'll hand back to David now. But as mentioned, we'd love if you could all maybe briefly either in the chat or raising your hand, if you could maybe introduce yourselves and where you're from, what your firm is, what your role is, and maybe your expectations or what you'd most like to gain from today's session.
Yes, indeed, Patrick. And indeed, if within 1 minute you could indeed present yourselves, what you do, and what are expectations for today, that would be great, so that we can best address them. And I can see that Alexandre has raised his hand. And after that, I will go through how you appeared on my screen. So try not to forget anyone. Alexandre, over to you.
Thank you, David. Thank you, everyone, for organizing this event. So I'm Alexander Aleg. I'm the chairman, co-founder of PowerMe, solar pay-as-you-go company established in Kenya. My expectation from this session is to understand better. So my background is more utility, energy, larger setup, and I'm always very keen to learn more about governance in smaller structures where you need to nimble, where you need to, where every day is a challenge when it comes to financing, raising money, different regulations, and so on. So very excited to learn more about your perspective on that. Thank you.
Thank you, Alexandre. We will. Next, I can see, well, then Adrian raised his hand. So over to you, Adrian.
Hello, everyone. My name's Adrian Narado. I work at NG Mobisol as the SaaS partnership manager for our PayGo software. And I'm interested in how governance could be applied to various companies, and also really interested to be in this training, as I also do various software trainings for our partners. Thank you.
Thank you, Adrian. I don't see any other hands, so I will continue with how it appears on the screen. And on the screen, I have Drew, who is with us for the beginning. So please, yeah.
Hey, good afternoon, everybody. I'm Drew Corbin. I'm the head of performance and investment at GOGLA. So working with our teams, looking at our member and industry performance, both financial and ESG. So we're really pleased that we've got the G part of this finally into our program. And yeah, looking forward to hear about, I think kind of tips and advice for corporate governance, particularly the smaller and younger companies, and how it can kind of support the companies on their path to growth and investments. Yeah. But unfortunately, I'm only able to be here until past, so I'll be tuning in for the rest of it via the recording. But yeah, thanks very much for today.
Thank you, Drew. On my screen next is Spook, but you introduced already yourself, and I see you next to you on the screen, your colleague Ran. Do you want to say a few words, Ran?
Hi, good morning, good afternoon, or good evening, everyone. My name is Rohan. I'm a project manager at Access to Finance at GOGLA. Through my role, I aim to enhance the chances for ODS companies to attract financing. I was also involved in the preparation of this training and looking forward to today to actually seeing it happen. And hopefully a lot of good tips and tricks for you all, and also for insights for me to understand how we can bring these best practices to other companies as well. Looking forward to today.
Thank you, Ran. Just beneath, I can see Ulrich. Ulrich, over to you.
Thank you. So my name is Ulrich Zimmermann. I'm the COO of Zimpertech, which is basically a solar home systems company. So we design and we also manufacture, but we are like solely in the B2B sector. Nevertheless, it's still very interesting to see and to learn then also about, let's say, challenges for the direct off-grid implementation companies, and also like how company compositions and so forth can look like.
Thank you, Ulrich. Next, I see next to you, Laura Fortes.
Hi, everyone. I'm Laura Fortes. I'm from GOGLA, project manager for investor engagement. And in my role, I do engage quite a bit with investors. And I think, well, this is an important topic to bridge the gap among investors and companies. So, what do investors need and how can companies learn? And, to bridge that gap, I think this is really useful for us. So I'm looking forward to it.
Thank you, Laura. And next, I can see Segun, that's you. Segun.
Hi, everyone. Good afternoon from Lagos, Nigeria. I work with a solar energy company called Consistent Energy. I'm the founder and the CEO. It's an early stage off-grid solar company, where the point of trying to scale our business and trying to raise additional funds, investors in. So I think it's a very critical point to get the necessary tips about corporate governance and how it can enhance our business. Thank you.
Thank you, Segun. And then Russell was kind enough to write in the chat from Zambia. Did you want to say a few more words, Russell? Please, feel free.
Sorry, I thought you said I should introduce myself in the chat.
Not only, but you have the floor. So if you want to take it.
That's fine. My name is Russell Lysite. I'm the MD at Vitalite Zambia. We're a last mile distributor with a kind of specific focus on solar home systems, although we want to diversify our income stream somewhat. And I'm interested in finding more about kind of board composition, the kind of potential value of subcommittees, how to attract and motivate the right type of board member. Those are the things I think I'm most interested in at this point. Although I would guess that as we go through the conversation, I'll learn a huge amount from the areas of focus that others have mentioned already.
Good. Excellent. Thanks for that, Russell. Then I have John Mark.
Thank you. Good afternoon or good morning, where you are. I'm John Mark Mwangala. I work for an organization called New Grid. New Grid is trying to provide credit reference services for the last mile in Uganda, especially solar and other renewable energies in the country. And I got attracted to this, governance training through Ron and Pook. I've been in touch with them. I saw it advertised, and I thought, because I'm just coming in as a board member for New Grid, this would be a very interesting learning point for me, so I can improve our organization. Thank you.
Thank you. Great, you have a board. Not all the companies do have a board. So sounds interesting. And there were several questions here, so we'll be discussing that definitely. Then next to you, I can see on my screen Samuel.
Yes, hello.
Hello.
I'm in Nairobi, so it's evening. So good evening. My name is Samuel. I'm a access to finance advisor at a company called GIZ. My role is I'm the lead implementing person for the Kenya component for the project called Sustainable Energy for Smallholder Farming. And the majority of the companies that we work with in the last mile distribution of solar products, especially solar for productive use products, early stage startups that are composed of management and governance structures that aren't fully developed. So I'm excited to learn a few tricks here on how to, number one, review or validate some of the information that we get from them, and also advise or provide technical support in enabling better governance. So yeah, thank you.
Thank you, Samuel. Then I can see Sami Chalier.
Hi everyone, I'm the CEO of Heri Madagascar. So we are a company based in Madagascar, and we distribute lantern and solar home system. And I'm here because we are closing our first investment round with a French impact investor. Contract should be signed the next days, and I wanted to have a bit more information about governance, because this is one subject which is coming very quickly for us.
Yes, indeed. So I keep my finger crossed for you, and thanks for making the time. I can imagine that it's extremely busy right now for you. The end of the year, plus the closing.
Yeah.
Next, I can see Thomas Devine.
Hi, I'm Thomas. I'm the CEO of SolarWorks. And we're not really an early stage company. We've been around for a while. So we've had plenty of discussions on corporate governance in the past. And while I'm not really usually involved in those, I'd like to know a little bit more about it. So hence my presence here. Look forward to hearing more in the next sessions.
Yeah, thank you, Thomas. And I think your experience in being a bit more advanced than some of your other colleagues could be actually valuable experience to share how you get there, because some of the questions we say is actually we'll be discussing how difficult it would be for you to get to the next stage, or what was actually difficult to get to the next stage.
Yeah.
So excellent. And I can see the last person, I think, who joined, which is Frank. And after we start, Frank, if you could introduce yourself.
Hello, David.
Hello, Frank.
Well, it is afternoon in Kampala, so good afternoon to you all.
Good afternoon to you. If you could say a few words about your position and what you're expecting from this afternoon.
Yeah, so, well, my name is Frank Nilvika. I am the founder and CEO of Annual Energy Uganda. My expectation, basically having the veil lifted on corporate governance, so that we could best utilize that resource to improve our company's strategic objectives, improve them, and put us on the right track. Thank you.
Thank you. Great. I think we did I forget anyone? No. Good. So maybe we can. Great. Thanks a lot for the introduction, and it will serve. Good to know where to focus. And we can move on, Patrick, maybe to the next slide and let you run the first Zoom.
Sure. Thank you, everyone, for your introductions. As mentioned, we'll be running Zoom polls kind of throughout this session. And the first one of these that we'd like to ask to you is, getting your opinion on how important is good governance for the success of your company, do you feel? And so you should see now that I've just launched the poll. And there are 5 responses on a scale from very important to not important at all. And great, I can already see a lot of responses, which is fantastic. Responses from 12 out of 13 already. One of the quickest polls I think we've ever done. So
yeah, I was about to say responsive and quick, and we have everyone.
Amazing. Excellent. In 30 seconds. So I'll share the results now, and fairly conclusive. So more than around 2/3 of you thinking it's very important, which obviously we're glad to hear, and 4 of you saying it's quite important, and none of you saying that you don't feel it's important or not important at all, which is a good thing to see, because as David's already mentioned, what's often the case in early stage companies is people feel that corporate governance isn't important for them at the start or when they're in an early stage, and they only start to think about the importance of good governance later, when often it's harder to put in place the processes, or maybe it's too late. So glad to see that you're all of the opinion that this is important, and we would of course agree.
Yes, but I suspect, Patrick, that there is a selection bias in the sample.
That's true. That's very
to
true.
one believer, it's not important, may not be part of this afternoon. But let's move on. I think if one of you would like to say why it's very important for you, that could be interesting. One of you wants to say why it's important? Point is not to please us.
Hi,
yes.
This is Russell. Yeah, I've got a couple of thoughts on that. So the way I position my role with our company is that I support my immediate team, they support their immediate team, and so on until you reach the customer, with me at the bottom going upwards. And then I explain to them that the board supports me. So my feeling is, if I don't have strong corporate governance in place, if I don't have good relationships, good individual relationships, productive critical friend relationships with the board members, then that foundation is at worst not in place, and at best ineffective and dysfunctional. So that's why I think it's important. And I've seen plenty of examples, both in mature and in kind of newer businesses, where that's not in place, and where the consequences are really material, really material. Yeah.
Yeah. Thank you, Russell. Any other views? So we'll see a few. We'll see a few in a few more. But that's indeed one of several. And sometimes having a dysfunctional board is more disruptive than not having any board at all. And we'll see why we should have a board. By Drew. So a quick introduction to governance, briefly, so that we are all speaking the same language. So we'll see that if there is no one similar shape and form of governance, but there is one overall similar understanding and definitions, and we can move to the next one here. Yes, starting with.
So we have another poll, and this one on how familiar are each of you with the concept of corporate governance. A range of options. So maybe I don't know much, and that's why you're here. You've heard of it, it's something you're aware of, but not something you've personally practiced or been involved with. You know what it is. You have hands-on experience, or you feel that you're an expert, that you know everything there is to know and should be giving the course instead. Fantastic. I can see 11 out of 12. One more to go, and we'll have a full set.
Yeah.
Amazing. So a decent spread, but more of a grouping perhaps towards the less experienced end. Around a third of you feeling you don't know much at all. Half of you feeling you have an idea, but it's not something you've practiced. And a couple of you saying that you have an idea and you feel you have some experience. So that's good to know. So we'll be hopefully trying to move those of you who feel you're in the not knowing much or you haven't practiced it, hopefully explaining more, and then in the next session really getting you to apply what you've been taught. So hopefully moving you firstly into knowing more about what it is, and then feeling that you've maybe gained some experience practicing some of the ideas that we'll be teaching or sharing with you all today.
Before we go to the practice, which is indeed more the second part of this afternoon, we will start with a bit more of the theory, but being very practical. If we can go to the next one, and Patrick, I'll let you. Let's try to launch the video, and then I will comment on that. It's a short one.
I need to.
Yeah, to switch to different screen. Yeah. Yes, we can see it.
Fantastic. You should have the sound as well, but let me know if you don't.
What is corporate governance? Well, it's not rocket surgery. It's what you can do to keep your organisation off the front page of the newspaper. There are various definitions. According to the ASX Corporate Governance Council,
corporate governance is the system of rules, relationships and practices that determine the direction and control of an organisation.
And according to OECD,
corporate governance is a key element in improving economic efficiency and growth, as well as enhancing investor confidence.
But in practical terms, governance means the system by which an organisation is controlled and operates, and the mechanisms by which it and its people are held to account. The word governance comes from Latin, meaning helmsman or captain of the ship. The board is principally responsible for ensuring the corporate bodies discharge their responsibilities to stakeholders. It defines the relationships between directors, management, shareholders, and the stakeholders. Authority cascades down from the board to the CEO and the executive management team and throughout the organisation. For a good governance practice, there are 4 essential elements: transparency, accountability, stewardship, and integrity. There is no single model of corporate governance and no one-size-fits-all approach. Good corporate governance is about working out the practices to make and carry out corporate decisions, and also monitor the decisions and the organisation's performance. It is not just about ticking a series of boxes to meet the regulatory requirements or getting tied up in red tape or bureaucracy. Professionals involved in this important area need to keep up to date with changes in legislation and regulation, market practice and expectations. Governance Institute of Australia is the only independent professional association with a sole focus on whole of organisation governance, helping to generate a best practice culture and ethics from the boardroom and beyond. You can find out more about governance at governanceinstitute.com.au.
So pretty from a bit far away, and so in this small video, do you think that all the elements of governance relate to you? And you had some of the definitions around basically the direction, the control, ensuring the accountability, the responsibilities, and these aspects. Are there any aspects of governance that you do not recognize yourself in what was described? No, so most of these principles are the reason why you recognize yourself is that indeed most of the principles can apply to a variety of organizations in general, whether they are for profits, small, large, because indeed, whether we look at the definition of the OECD, the older person here is Sir Adrian Cadbury, who drafted the first corporate governance code in the UK, which was the first corporate governance code ever drafted. And Sir Adrian Cadbury was the family member and Cadbury Schweppes company. So he thought a lot of governance, and from a very practical point of view, we put that governance is the system by which kind of companies are directed and controlled. So it's a lot about the future, the direction, and the control about how you ensure the decision makings. And you have a few principles that were introduced in the video, such as accountability, such as well kind of fairness, responsibility. There is one that will see transparency. So these are the principles that we'll be putting into practice very soon, but that have kind of one aim, which is kind of ensuring that the decision making is effective all the way long, and ensuring that it's made in the interest of the company itself, and providing the right accountability to provide a trust to the different stakeholders. So in a nutshell, that's what we understand when we discuss governance. And we'll see that there are different forms of it. If we can then maybe move to the next slide. And if there are different models of governance, there are a number of questions that you can always ask yourself, and see that these are often the questions that investors do want to understand. And you actually, from even from a board perspective, or kind of, if you are the CEO of the company, often you have the response about who decides, but often the who decides may not be the same as what is on the organizational chart. A lot of is informal, and in particular in the type of organization that you have with your state, with your different stage, you can think of who implements the decision, who actually really controls these decisions, and what are the different interests that have been served. And I can see that there is Drew. Yeah, okay. Has to drop in the chat. So then, is there a single model? As a model, we can see that the answer is no, and then we can apply. So that's the first one that we can see is essentially the owner is the same as the manager. Owns all the company, so really kind of the founder, and one of the aspects around governance that we see often is the principal agent relationship. So the one who brings the money is not the same as the one who is using the funds, which is in early stage companies rarely the case. Only sometimes you may have, and which is the second part of the second stage, which you have a bit more shareholders, so kind of first rounds of financing. Often the manager is still one of the owner, very often, but not necessarily. And then you have a board that is often in between the two, meaning that the board is very operational, and we'll see that discussing a bit later, that one of the functions in early stage companies is actually the board is there to be very supportive to the management. And I liked very much what Russell was describing in his role, and how the board was supporting him as well, because that's what one would expect from the board, especially in that stage. And we'll see as progressively the company matures, the board is getting more in his as well control mode as well, rather than only the supportive and a partner. But in the beginning, it means that the board is often very active. Having sat on the board of startups as well, we have met, and sometimes we can see the board often meets on a monthly basis. It's really frequent, sometimes even not more, depending on the topics and the issues. So the one that you see totally on the right side, it's more the model of a listed company, where you'd have a number of important owners, where you'd have majority shareholders, a few more minority shareholders, when then often the manager is not one of the owner. So you have really a professional manager that is not necessarily the founder. And there in this configuration, the issue is very much about ensuring that the board is effective, so that it can represent the proper steward of the different shareholders, while the one in the middle, often the issues that exist are more around the clarity of the roles between the shareholders and the managers. So you can see that the models vary, and there is, obviously, that's all what we want to say. There is not one single model of governance, and in your case, the trade-off will be about setting up the right model, having the right formalities, without kind of burdening too much the organization and preventing you from deciding fast and executing. The next slide relates a bit what shapes governance. So there is no need to spend a lot of time on it, but there are many influencers in the sense that shapes the governance, from the laws and regulations, some of the standards. We've been right now as a firm developing the corporate governance code in Cameroon, for instance, so that there will be a code in the region. So you have corporate governance codes that influence that. You have as well kind of the source of financing as well, the importance of banks, obviously on top of that as well, the shareholders, how engaged they are, how concentrated they are in the organization, how vocal next to that the stakeholders are, and their willingness to be engaged with the company and how they can influence it. So not to mention some of the reputational agents like through medias, for instance, or if you are kind of a larger institution down the line, you may have rating agencies and others. So all of that will shape your governance, whether you have a chair and CEO, whether you have different committees, how your controls are organized, and so on. But if you have different shapes of governance, you have a fundamental 4 principles that comes next. And these 4 principles are the one that when kind of re-promoted by the OECD, OECD being the organization that promotes kind of the economic development and that has established the first corporate governance principles back in the late 90s. The 4 pillars of good governance, so regardless really of whatever organization size or for profit or not for profit, is around these 4 pillars. One is responsibility. So what do we mean by that? Here is that basically you need to have person responsible for making the decisions. So in other words, if you are the CEO or managing a specific division or activity, you want to be empowered. You want to know who will be deciding, and not necessarily another person who is not necessarily empowered to decide on that. You don't want to have someone else committing the company without you knowing that's the case. So responsibility is that people have to decide, but they should be clearly identified and be empowered to do that. The accountability is close to it, simply mentioning that if you make decisions, you should be held accountable for the decision you make. It's very easy in the beginning because it's often with your own money, so you're very much accountable to yourself. But when it starts to be a bit more complex, sometimes you have a board. We discussed the board, so you are kind of held accountable by the board on behalf of the shareholders, for instance. A recipe for disaster is when you have people who are responsible but not held accountable. Part of it as well is transparency. So here it's the information, and the information means information that is running inside the organization, so to decide. So the information that is brought up to the board, your different kind of dashboards, KPIs, the financials that you follow, your different operating performance, and so on. So that's the information that here there. But within the organization as well, the information about who is responsible for that, what are our different kind of processes. So people should be left aware and know where the company is going. So that's the internal kind of aspect of transparency, which is extremely important, kind of top down and bottom up as well. And then you have the transparency outside the organization. So all the disclosures that are very minimal at the stage as where you are, and you will see as you will grow, your stakeholders will expect a bit more, starting with your shareholders when it's not you. So the transparency is an aspect here, and which links very much on the robustness of the information. And then the fairness aspect. Fairness is linked to simply the fact that if you want to build your company over time, and you're all entrepreneurs, you do want that, or help investors, you all want that. And fairness is extremely important. If you don't treat fairly your shareholders, if you screw them, if you don't treat fairly your employees, then they will stop working, or your kind of clients, they will stop working with you. if you're an employee and you see that you are not rewarded properly compared to other colleagues that do not deserve, you will start looking elsewhere. So fairness is actually what helps the company to project itself in the future as well. So keep the main stakeholders and shareholders trusting the company and ensuring that you engage relationships instead of simply transactions. And that is another fundamental pillar that develop trust. Any questions or on what I just said or reactions? No. Yes, Russell, please.
Straightforward in terms of understanding it. It makes a lot of sense. And I've not seen it presented with this kind of holistic approach before. So yeah, it's useful.
Sorry, I didn't get your question, Russell, then.
Sorry, it wasn't a question, more a reaction. Just I've not seen it. I've not seen the principles expressed in this kind of holistic way before, and I think it's useful.
Okay, yeah, thanks a lot. Right, I think that if you get that, you can get any other types of kind of the governance practicalities that goes behind. And I think that as a manager, you will get most of your leading principles right following this compass. Now you have as well, besides that, you have as well as a number of sources of good practices, and we start to go here. In a sense, we discuss the shapes of governance, and you have a number of shapes from the corporate governance principles, and here you have a few sources from as well from the investor side. I think the box in the proxy advisors and others are really far from where you are. You are not listed yet, not yet. But another source of really good governance best practices is often your peers and your network. So that's an aspect where we've seen a number of companies turning to their either board members sitting on other companies that they know, over CEOs and networks that really can help kind of disseminating some good governance practices. The initiative of GOGLA is actually one of them, because bringing together a number of peers. And then as well, you have guidance, and these two guidances will be shared with you from both FMO that has worked on that, and the IFC that has worked a lot as well on the early stage companies and principles. And I see that, Juan, you've raised your hand.
Sorry, I was muted. I just had still a quick comment on the last slides you had. Just one thing that we've heard in the past from some of the members, because sometimes in the board you also have some investors in there and some shareholders. And at times members do indicate that sometimes it's a little bit problematic. On the one hand side, of course, you want to be transparent and you have to be transparent around your performance. But on the other hand side, you also have an interest in getting more funding perhaps, or showcasing that you're a good bet. So at times it's difficult to strike that balance a little bit and being transparent and perhaps also defending your own interest, let's say. So I was just wondering if you have any comments on that or recognize that.
I think it's to me it goes with two aspects. One is, you're right, the transparency is how much should I share and what I can share, but that's why you have, I think, the fairness as well and the trust. So in other words, if you start, transparency doesn't mean that everyone should know everything about, but they should know what is important for their decision making. So if a shareholder needs to make the further round of investment to get some information, that's why you have due diligence, is try to break the asymmetry of information and get the information right. But if you are telling kind of the story knowingly that you won't make it and you are making that up totally, you are breaking kind of the fairness more principles, and down the line, actually you will be labeled as someone who actually abused somehow the shareholders, and it will be very difficult for you down the line to raise further funds. there might be a zillion of reasons why you don't meet, but one thing is voluntarily hiding things. The other one is really believing in the project and developing a business plan, which we all know whenever a business plan is never achieved. Either it's overachieved or under, but it's very rare that companies really are on the plan. But it provides the indication on that. But that's a good point, and we'll come to that, because another point is my hat as a shareholder versus my hat as a board member, and that I think it's important to distinguish both, because the interests served are actually very different, and we'll come to that. A board member, just opening, should defend only the interest of the company, the long-term interest of the company, not the interest of a specific shareholder. And moving on, we discussed the principle. We'll be discussing now the next two slides actually are the components of good governance. And often, and we start to introduce you how the investors often look at governance. So we at Nestor, when we look at the governance of a company, we look at the leadership. So it's a lot around the board, whether the board is independent. So the independence of the board is, what does that mean? It's independent from the management, independent from the shareholders, but more importantly, it's independent of mind, so that it can really defend the interest and think of the perspective of the company as such. So it shouldn't serve a specific interest of one manager versus shareholders, or serve the specific interest of one shareholder. It's really defend the interest of the company, and that's what it's meant really by independent. Obviously competent, you need to know the business to help. And knowing the business is, depending on in your case, and some of you presented the importance of financing and having the last mile towards the customer. There might be some logistics aspects. There might be important IT dimensions, obviously, as well. So your board should bring competency around strategy, around the knowledge that really supports the business model, and that's what we need by that. And obviously engaged, because if people are competent but remain silent or do not get ready for the board meeting, it's totally useless. So that's this aspect around the board and the leadership, and most of boards really are there to, one, support the management, act as a sounding board and support the management, and then as we see, kind of ensuring that the tempo is kept, that the project is moving as expected, and hold management for into account for its decisions. A second building block, which is definitely not the first building block when you build your business, is around internal controls and risk management. So a lot of risks are implicitly managed for your daily thinking, but you don't necessarily have the risk management framework in place as such or formalized, and kind of the decision making aspects and transparency around that is often lacking at that stage. Again, here we're presenting the components, and importantly, and what we'll see in the coming hour, are the different building blocks around that. But in terms of maturity, it's often the internal control framework is not what comes first. As controls, often what comes first is controls around your cash flows, your financing, and around the quality of what you deliver. That's often where the first controls come first. Then we go to the quality of information. So I've developed that a bit on the transparency aspect. It's really to ensure that basically there is material. So the materiality means that not all the information should come to everyone, but the one that really matters for the decision making, and that is arrive on time and that is reliable. It's essentially that, and then the external aspect of disclosure that I've already mentioned. Another important dimension in the governance, when look at it, it's really how people are aligned in working toward the same direction and the same goals. So in other words, you align your people behind you through incentives. Some may have shares or options. Some others have have simply a specific financial interest and remuneration that is assigned accordingly. But as well, you may have values, a certain sense of leadership that aligns people behind you, and a peer pressure of doing things right, or on the contrary, in screwing things and shortcutting, which is a rotten culture. And that's why now a lot of boards and investors now look very much into the culture of the company. Because that is one of the grounding principles of how the organization, not only the what the organization does, or the what it delivers, but the how it delivers it. And then you have the shareholders and stakeholders protection. So meaning that the first point is enabling shareholders to vote on important matters at AGMs or at specific aspects that may relate to approval or related party transactions, for instance. And that's the protection that is offered to the shareholders and stakeholders from insider abuse, which is often actually the abuse from a manager, because he's kind of there is an overlap of his own wealth and the wealth of the company, for instance. So that's the main aspect that makes a good governance. And the next slide is actually almost the same and organized the way most of development finance institutions look at it. So in institutions such as the World Bank IFC, the Dutch FMO, the German DEG, I don't know about these actually. I think there are signatories as well, have to double check. The French Proparco and AFD, or the British CDC, and actually there are 34 signatories that look at governance that way. So with what's the commitment to good governance, how management is recommitted to change, to get for the formalities right, the kind of really the willingness to set up potentially a board and these aspects. So they look at the commitments to good governance. And the second one, which is developing and structuring the board. So they will look at how the board is organized. They will look at the control environment, the transparency and disclosures, and the treatment of minority shareholders and stakeholders. So basically all what we've discussed before, these are how the different DFIs are looking at governance. And the coming slides, we will take each of these 5 areas and look at the different stages and what is expected from companies and organizations in around these 5 areas at every kind of stage, essentially from we'll see from kind of starting to have it to be in a growing mode and starting to raise Series A or B as a source of finance. So that's what we're gonna do in the coming hour. And before we discuss the value of governance, I don't know if there are any questions or comment. No, not yet. Not yet. We will, as you see, we will go them through each of these areas one by one. But before that, I'll pass it back to Patrick.
Thanks, David. So to kick off this section, we have another poll for you all. And here we're asking, how do you believe the good corporate governance, the ideas and the principles David's just been discussing, can add value to businesses? So it's a single choice question, although you may think that more of them apply, but which do you think is the most relevant? So expanding access to finance, reducing organizational inefficiencies, enhancing the brand, improving shareholder and stakeholder relationships, reducing risk, improving the growth outlook, or something else? Is there something you feel is maybe missing that you think is really important, either to your firm specifically or in general? And again, I can see a really good response rate. We've already got 10 responses, just waiting for a couple more. Can we get that one more response, and then we've got the full set again? Maybe just give 5 more seconds. Okay. So again, we see quite a strong grouping, in this case around the fourth option. So reducing risk, improving the growth outlook, and increasing the potential for long-term business sustainability. And then a couple of you thought that it would expand access to finance, which is a very interesting point that David will come on to. And another couple of you thought it would reduce inefficiencies and improve strategic decision-making. And I think not to spoil things or get ahead of David, but I think really in reality, you can say that it's all of these things. That it can add value in all of these ways. But very interesting that you thought that the fourth one was the most relevant, and I think that's a completely fair response. I think that's a very good point.
And actually, that's well, if that helps, if governance helps to access finance or to access finance at a cheaper cost, because governance is assumed to reduce risk. So that's, in a sense, the root cause is really what you highlighted. Maybe I would be interesting to know for others, the one that have kind of went a bit further in their own governance, such as Thomas, for instance, or the one that have a board already, the experience in what kind of risks. I mean, 2/3 of you have responded that it reduces risks. What kind of risks do you think are the most kind of or the best mitigated through good governance?
Well, I actually went. Sorry, this is Thomas here. Went for the second option because I think that's sort of the one at this stage that we're seeing most of. With all we have quite a few different shareholders and stakeholders, and just having sort of the structure that we have now, with the right stakeholders also involved at board level, just helps a lot in keeping everyone on board, and when there's important decisions to be made, making sure that everybody is on the same page and we can sort of move forward as one.
Anyone wants to add something? Because indeed, I mean, one important kind of type of failure we've seen is that when important decisions are to be made, and when not all the actors, meaning the founders, the different actually shareholders, and that's thinking of the one who raise finance, is extremely, I think, extremely important to understand what are the expectations and the time horizon of the shareholders that will bring finance to your company, because what is at stake, the expected rate of returns or the growth, is not the same if you have a 6 to 10 years time horizon versus if you have a 3 to 5 years time horizon. And then there might be some trade-offs in terms of capex, investments, priorities that may bring tension into the around important decisions that to be made. So the alignment is extremely important. I could not underline that more, and I totally echo Thomas. Any other experience of how governance has added or destroyed value? Alexandre?
Yeah, I don't know if this would count as one. You can stop me if it doesn't. I was on the board of an organization in London at one point, and the CEO transgressed the code of conduct, and the board was supposed to act at this point, and because of personal relationships on the board with the CEO, they didn't feel comfortable acting in line with what the code of conduct told us to do, and that subsequently caused 2 board members to resign because on point of principle, and that caused quite a degree of instability for the board, obviously, for the CEO equally, obviously, and for the rest of the organization as well. So that was an example of it failing and causing a kind of instability. Yeah.
Right.
This is Alex. This is Alex. I just have an example, not from my current company, but sorry, from the previous company I used to work for. It's not a startup, it's a big utility company, where there was a major breach of governance, where the chairman of the company was directly interacting, giving instructions to people reporting, to employees reporting to the CEO. So basically the CEO was bypassed in many occasions, which was ultimately, I think, very dangerous for the company, especially if you hold the CEO accountable. And this ended up creating a lot of issues within the company, because the chairman was very micromanager, getting into every single level of the company. And that's something we often see with chairmen that are founders as well, where they really want to get into the operation part.
That's both are excellent points. I think the point of what you mentioned, Russell, is simply a breach of trust. So that indeed leads to a dysfunctional relationship between the board and management, obviously, and further down as well to potentially shareholders. And what you mentioned, Alex, is something that is, one, reminds the principles that we mentioned, so responsibility, so knowing exactly who is deciding, and distinction between what exists on the paper and what exists in practice. The CEO should be deciding. In practice, it was more the chair that was very micromanaging. So that's one aspect, and having the clarity around that is indeed a fundamental governance pillar, as we've seen. In practice as well, that often arise when you have either that one of the shareholder is another founder and someone who was kind of used to lead companies and is no more in a venture capitalist business angel mode, and that is not well practiced. So in a sense, kind of can't help himself or herself to get involved in the business more than it's been required. That's one, and often as well when you have the founders that get a bit more kind of a step back, become only chairs, but as well can't help kind of continuing moving on and interfering in the business. That is hence when you have such a person, it's important to structure your board. Getting to Russell's question actually about the board composition, with someone that would take a person recognized with the sufficient gravitas and who is able to say to the chair, hold off. Now the role as a chair is different as being a chair rather than the board of than being the CEO, and there should be clear distinctions between the two, and sometimes it's more kind of the independent or outside person with the sufficient gravitas who can remind that. So hence the importance of the clarity of roles and communication behind that. Great. Moving on. Here I will relatively quickly go through that, but basically that's how shareholders do appreciate the value, in a sense. The first one is you have 29s already a few years ago, but emerging market focused funds, and all of them say that they are ready to pay a premium for better governed companies. So the premium is for half of them, about 10% for better governed companies. And they mention that in emerging markets. So what research shows is that better governance pays off more in emerging markets than in developed markets, where institutions are way more established, and the difference between well and badly governed companies or the shoulder protection is stronger than emerging countries, where really if you have a good governance, that pays off. You really stand out. And I will go directly to the survey from the IFC on the 264 companies that they had in their own portfolio, and they surveyed that between over 5 years, between 2011 and 2016. And they looked at these companies, and they found that basically they had a better credit risk rating. The companies that improved best their governance during the investment. And here, improving is important because you will see, and we'll be discussing soon, the journey of governance, and the governance is maturing It's more like they call it the maturity matrix, by the way, the AFC. So the improvements are important, and the one that improved the best kind of achieved a 20% higher return on equity or return on invested capital. And the same taking in their portfolio, because they ranked and they scored the companies as per their kind of the governance quality, essentially along the lines that we just showed you. They found that these companies had return on equity. The top quartile had 3 times higher return on equity than the bottom quartile, if they're organizing their portfolios on the basis on the governance quality. So it shows that governance really matters for investors. It does as well for companies, and that's the next slide. And the next slide here is again taken from the AFC, and they have here you will see, and again I repeat, you will receive the slides, and as long as the two FMO and AFC booklets on growth companies. But here that's another study that the AFC has done on the corporate governance success stories. So they have compiled success stories on a number of companies. Here, that's one of them, which is a family-owned agribusiness actually in Egypt, and where they try to measure the impact of governance from the management point of view and from the owner's point of view, the family, and they mentioned the kind of the impact that it has, and actually all of the measures in terms of improving governance had either a substantial or a strong impact, except kind of more moderate impact on the board effectiveness. But that's a company that already had a pretty well-functioning board at the time. So the aspect here is that management as well and companies do appreciate that, because it has an important impact on their profitability, as this showed, because you can better manage your part of your risk, your business. You have focus on the information, on having a board that provides you different echoes and sounding boards, so you may have be able to better navigate, increasing your organizational effectiveness for the clarity, and often enhances controls that helps actually to as well to improve your profitability. So that's the point of view of the companies. So both investors and companies do appreciate governance. Now, I think the question is more about having the right governance for the stages as where you are, because in a sense we can say that governance exists regardless, right? It's a bit like in a family as well. Huh? There is always someone in an organization that will decide. The question is whether the governance is fit for your purpose and your stage. And that's what we will see now.
So we have another Zoom poll here to kick off this section, where we're really going to focus on the different stages of company growth and what is maybe the most important or useful governance structures dependent on where your company stands in that development. And so the first question we have here, going back to investors, is why do you think, and you can pick as many options as you would like in this instance, why do you think investors care about governance in early stage companies? So as a way to improve performance, as a checks and balances on founder dominance, as a way to reduce reputational risk, as a way to reduce investment risk, as a way to increase accountability, provide better oversight and decision making, to support a development mission perhaps, or some other reason. If you can think of another reason why investors might care beyond these 6 options. And again, this is not a single choice answer, as many as you think are critical or are important. And I can see we have about a 50% response rate so far. So a little bit more time for the remaining people. Very interesting set of responses so far. Just waiting on a couple more. I think maybe 10 more seconds. Great, thank you all again. So this one I think is interesting, especially given as you were able to choose multiple options to see quite a spread, although with one or two that I think are really standing out. The increased accountability, better oversight and effective decision making. I think that's something we've really touched upon. Accountability, one of the four main kind of principles. Reduction in investment risk, reduction in reputational risk, founder dominance, improved performance, all receiving a couple of answers. I think also interestingly to highlight is that none of you selected supporting the development mission, and also none of you thought that there was sort of another thing that was maybe missing. But I think an interesting set of results, and definitely interesting to see a relatively even spread, I think, across the options.
Yeah, no, I think the ensuring the accountability is indeed something that actually helps as well to some extent to kind of counter the founder dominance if that exists and to reduce over risk. So I think again that's the response is indeed right, and the fact that it's a bit of all of that. So it's I'm not that surprised it's equally spread with the development missions and others, and it comes from as well some investors' impact that have that in mind actually. But what we aim at addressing and what governance often kind of the main challenges of early stage companies, it's governance would address aspects such as over-reliance, but over-reliance on key people. So often when you have a founder, the activity and one of the aim of governance would start to, as the company grows and the organization grows, is to have a more collegial decision making and kind of having a 2-3 key executives that will take part of the decisions. So to mitigate the key man risk. It's the second point is indeed exactly what an illustration of what Alexandra was mentioning. It's ensuring as well the proper succession planning at every levels of the company. So you have again key peoples that you need to ensure that they will be potentially replaced, but as well simply as the organization grows, often the people and the employees or your colleagues kind of grow with it. So you need to ensure that everyone is still fit in his or in her role, and as well ensure the continuity around that. You may have to mitigate the family versus the business relationships. Again, the use of assets, the consideration as, for instance, I will. Then this morning we've been advising a company that is actually closing as well its round of financing by the end of the year, and here we discuss quite a lot of the role of the families. You have the founder is the CEO is the founder, his younger brother is the COO, then you have the kind of the sister who is actually taking care of the accounts. So the investor is trying to understand a bit how it can mitigate kind of this family risk potentially, which is on one hand it's a strength because people are committed, are glued, but on the other hand it might be on the accounting side, for instance, you may want to have someone who is a bit more kind of independent to have a close view of how the resources have been used, whether they are used to the profit of the family. Or on the contrary, whether it's the family that finances a lot. And in many instances, actually, it's the family who provides a lot of financing and resources to the company as entrepreneurs, but not always. So, and sometimes it reverts. So after having considered, I've given so much to that company, I deserve the return, and sometimes when it's a bit blurred, that's what is that may lead to issues, and actually it's management of different conflicts. So that's what governance should be addressing as well as strengthening the risk management. So these are the different aspects that the different components of governance are addressing, and that we will see in a bit more details right now. Here, it's just an overview of the different stages from kind of the startup stage to where really the company is kind of small. It's less than 50 employees, sometimes many times way smaller, and where the main focus is developing the products, testing the market, and really trying to have the proof that your service or your product can be sold. But you are in this development mode. Obviously, often you are making losses, so hence the family contributing a lot, hence the need to get external investors as well to finance that. Then you arrive to a more kind of active growth stage where the size, there's no golden rule here about the size, but it's more about the stage where you increase your sales, your growth. You start to think of a variety of products, and you already have a client base that you've been developing. Then you are targeting to be break even. Sometimes you are a bit beyond, sometimes not yet, but that's the stage, and it's often the stage where you are really in a position of getting Series A funding, for instance. Then you are more in the stage of organizational development, where you really have already a client base. It's more you are starting to change and optimize your organizational structure, so to ensure that it grows as your revenues are growing, that you start actually formalizing aspects, and we'll see that, and you are in a sense beyond break even. And the next stage, which is you are getting closer to well-established companies and you are kind of managing the expansion. The focus here on the next and coming slides is between the stage 2 and stage 3. That's where the governance challenges and the governance feature that we'll be presenting to you now into more details are really focusing on these kind of moving from the stage 2, where you are still kind of in the making, and to the stage 3 where you are getting kind of ready to really face the market, have the resources, and how you get there. And the how you get there, there are a number of in a sense risks that we've tried to highlight. I won't go in depth for all, but I will be focusing on kind of the risks from the stage 2 to the stage 3. But often under the stage number 2, okay, you have grown, but the policies, you are not very kind of formalized, and that's what the investors are often kind of unclear about how things are done or who is responsible for what. The checks and balances are not effective yet. So in a sense, there is no because there is no clear process of sometimes you are not equipped to properly measure the performance or the performance of individuals. There is no real board as well. So that's kind of a risk that often investors try to mitigate. And for the business, it's really to ensure that you still have the flexibility that characterizes you and stay nimble, in order to continue growing, but managing some of the risk that starts, like ensuring that you have the right focus on strategy, and as well an aspect where you may start facing is kind of a bit more siloed approach, where because people are so much in the operations and running, that sometimes there is a risk of not starting to lose the relationship that were easy to establish when the company was smaller. But as the company grows, the communications between department or between activities are not as fluid as they used to, because simply there are more people, and then actually there is a need to establish that. So that's often one of the risks for the business. And the stage number 3, in a sense, where investors will be looking at is, now how can I professionalize a bit more the staff? So it's the time to be more professional in your approach. So it's developing a number of kind of processes, that can help to repeat actually the production, the delivery of the services when it's well processed. The way you can really identify as well some of the measure the quality, and as well it's the time where some people that were good in the beginning, some of the family members or friends, are not necessarily the best people in place to continue taking the company further, not always, and or needs to be trained, and that's part of what GOGLA is offering as well. Is to help you professionalizing yourselves. So that's what investors would look at, and as well managing as a risk between the person who are kind of the founders, some new management that may come, the investors. I mentioned the time horizons might be different, the expectations of growth in terms of responsibilities might be different. So sometimes these different expectations added with the lack of clarity may be a source of conflict. So that's one aspect that investors often keen on trying to mitigate. And for the businesses is really to be able to expand properly your staff and your offering, but in a context where often your supportive structure might not be able to keep up. So because you are in the need of resources, that's one, and then the incentives as well are important. I don't know if someone wants to add or comment on your own experience here between the stage 2 and stage 3 before we deep dive a little bit in the different governance components. Does that sound familiar to you? Or where most of you are?
Yeah,
yes, Russell.
Some of the risks to investors, not that I've seen them where I am at the moment, but I've seen those ones at a previous role. Yeah, and again, it was a big issue at the time.
Which one, for instance? You want to say what it was and how it was solved?
Conflicts between founding partners. It wasn't really. It was solved in court.
Yeah.
Rather than internally, but I think that a stronger chair and a stronger set of relationships between the parties might have avoided that outcome.
In a number of kind of companies at that stage that sometimes try to read to go for like is not necessarily the founder actually, but sometimes that the founder could either know or really respect in any case for the experience that he or she can bring, and that would provide at the same time a lot of comfort to investors, where would help kind of actually to fuel and to oil the relationship between them. That's one. And something that I've often discussed with investors and private equity and impact investors, where we were discussing governance from the investment point of view, and we are focusing very much on the quality of the governance of the companies, but where a part of often the discussions go to the expectations of other investors. So it's not rare where the investors do know each other very much, where DFIs, the European Development Finance Institutions, for instance, more than half of the investments are actually co-investments. So they co-invest. The reason why is that they know each other. They are relatively same time horizon, same expectations. They are more patient than some others. They are reputational agents, and they rely on each other's kind of approach. And for you who are kind of looking for finance, that's extremely important. So several were mentioning, for instance, that in their investment policy, their role was to be a minority shareholder. So at the point they arrived, they were two shareholders, kind of two funds that were co-invested. And when the company needed a further round of funding, one of the two funds didn't want to follow, could not actually, because the fund was close to closing in terms of it was a closed-ended fund, that the other fund actually couldn't be alone because its own policy was not to become a majority shareholder. So it had to divest as well, considering that the value that it was expecting was on the longer term value. So it's important for you to choose the right partners that will really bring you the expertise, the access to network, to, in a sense, not only to fundings, and understanding well the cartography and the mapping of your different potential shareholders, because it's important they are well aligned as well in terms of expectations. Great. Patrick,
Yes, thanks, David. So having kind of given you all that information, we'd like to ask a simple question of which of these four most resonates with you? Which do you think is the most applicable for your company or your firm? So startup, active growth, organizational development, or the final stage, business expansion. That's great, getting about half of respondents so far. Give maybe 5-10 more seconds. Any more? Okay. So maybe slightly surprisingly, none of you consider yourself to be in the early stage, in the startup stage, and then just over half in the active growth, just under a quarter in the organizational development, and the final couple in business expansion, which I think is useful given we'll be focusing on really that transition from 2 into 3 and then on to 4. So I think that's perfect for what the rest of the session will focus on.
And here we start to remember the 5 boxes. So here we provide a synthesis, and I think you can put the 4 stages together. Thanks. Where in terms of commitments, we will quickly screen of what is expected to be seen in the sense at each. So at the very initial stage, it's more about first knowing that the owners has a view of what he wants to develop. Often it has, so that's a key aspect, obviously. And then the ability to really identify what are the needs in terms of the organization to have in terms of kind of core competencies and be able to distribute that among the team. I've seen, for instance, an org chart that was interesting again this morning, biased, but the org chart was not composed of or based on the people that were in the organization, but based on all the functions that the organization had to meet. So you had under different functions the same name. So the persons were wearing really different hats, but it was more about, okay, I need this type of function, I need this type of competencies and so on. And one person was filling 2 or 3 roles. And as the organization was growing, they will know, that the first one of our priority will be to address that position, for instance, and so on. So that's one aspect. And in a sense, if I move towards the stage 2, it's that the key positions, you are able to fill them and you really kind of start considering and developing a few basic policies like a code of ethics, what you expect from people, some basic rules of works around health and safety as well, potentially the basics around information flows, and that can is a sense a first grounding stage for showing good commitment to governance. On the organizational development stage, here it's more, and what investors want to see is that, okay, you start to document some of your governing bodies. So if you have a board, for instance, then it's to really delineate what's the role of the board versus the role of management. How does the board would function? How you would nominate or promote some of you, nominate people at the board, but as well how you would promote and nominate some of the kind of collaborators, and potentially having someone who is not necessarily a full-time role at all, but someone who is kind of more in charge of structuring that, helping the governance framework to be shaped properly, and have these resources is something that often kind of is been asked. And the reason why a number of investors do ask for that, or at least the impact investors that I mentioned, is that after the kind of a due diligence stage, they will ask you to. They will come up with a governance improvement plan, potentially, or at least a few actions to be taken to go from your stage 2 to stage 3, or from your stage 3 to stage 4. And to operationalize that, it's important to be able to rely on someone who can improve governance, so who has what's called in the stage 4 the company secretary function, that supports the board and often is the person responsible for governance around the providing the right support for the board members, but as well on disclosures and monitoring the implementation. So that's I would say these are the aspects that are kind of looked at in relation to commitment to good governance. And the next slide really details more the stage 2 from the stage 3, and there are three, in a sense, main buckets. That one is really the awareness and commitment of the owner to improve governance. So, for instance, that the owner is not reluctant for setting up a board, for instance. It's so it has kind of signal already different aspect that demonstrate that is his or her willingness to good governance. It's setting up the tone at the top. So, for instance, ensuring that the right behavior is in place. The organizational structure, it can be as simple as establishing a right organizational chart and reviewing that regularly, trying to have in that having a clarity on the different roles, so that helps to structure the organizations, and that's what is often looked at, and having a few key policies around the conduct, around the calendar of the company events, that can actually support the core processes of the company that are kind of properly defined, and hence you can apply some preliminary controls on them. You know what is expected and what should be expected. So that in a sense defines this kind of first stage here, I mean the stage 2 to 3, and in the category of good commitment to governance. So from growth to really professionalization. Are there any points of view where you are working on these topics? Yes, no? No, I'm sure they will be over. So let's here it's a case example for the, I think, the sake of time. It's a client of ours that's actually an impact investor are invested in, located around the Mediterranean Sea, and working around kind of agribusiness and packaging. Next week we'll be really focusing on the off-grid sector, and the energy, but here it's a number of challenges are kind of a bit looking alike. So here, what happened is that they, for instance, the company appointed a person kind of that was trusted by the family, because the family as an independent director. So in a sense, what we discussed to mitigate the risks. So there was as well kind of a discussion around really delineating the org chart and the clear roles of the chair and executives from actually preventing what Alexandra was describing before. And there were actually periodic board meetings that were set up in order actually to inform, including the chair, and with a right process. And these are the processes and policies that help kind of to start preventing the interference from the chair and from some family members into the business and into the management. So few aspects and solutions next to that. Patrick, we can move next.
Sure. And we have, based on what David's been talking about, another question for you all. Based on those kind of 7 bullet points that David showed you, and again, you can pick multiple options here. Which of these criteria that David discussed and are listed here do you think would be the most challenging for your company to meet? So discussing the importance of governance with management and staff, setting the right tone at the top, articulating a long-term vision for the company, appointing someone to be in charge of improving governance, conducting periodic reviews to evaluate the organizational structure, appointing someone to monitor adherence to company policies, or finally developing a calendar of company events. Which do you think would be the most tricky for you as a firm or you personally in your role? And we can see about half of you responded. Give it a little bit more time, but not too much, because we're getting towards the end of the session now. Maybe just 10 more seconds.
That is interesting, because
That's
in the
great.
view of next week, that will be I think important to know. Yeah.
Great. I'm going to share the results. Again, a bit of a mix, but more people thinking appointing someone responsible, conducting periodic reviews, or appointing someone to monitor adherence would be the hardest. I'd be interested to know if that's for reasons of cost or reasons of diluted focus. And then a couple of you thought that setting the right tone at the top was hard. Fewer responses for the other 3. So a calendar, a long-term vision, or discussions. Maybe fewer of you responded thinking that those would be tricky. Thank you.
Okay, moving next, which relates now to decision making and strategic oversight, which is very much about the board actually here. So here, if we focus on kind of the stage 2, here it's try to stop the fact that the founder entrepreneur are often isolated or alone in that, and have a collective decision-making body. So often it starts with 1 or 2, for instance, the one trusted advisor that is identified and works, where you may have as well kind of organizing the clarity on the delegation of authorities. When some decisions start to be made in collaboration with other executives, so these kind of collective decisions that starts to emerge, and is kind of emphasized and continued on the stage 3, where now it's a more structured approach towards outside advice. Which, what does that mean? It's these companies may set up either an advisory board as an introduction to a board of directors that can kind of be established either on stage 3 and stage 4. The advisory board, the advantage is that it looks more about discussing the challenges, some of the strategy aspects, the problems and issues encountered by the company, without going too much in depth into the accounts, into the financial performance. So that is in a sense the advantage, because sometimes founders feel a bit reluctant to open the books to a board. But obviously, when you start to have equity partners, you have a board, and the issue is more how to staff the board. And I will stop here, because kind of I remember Russell's expectation on board composition. Often, typically, you would have one relatively small board. So meaning small is often around 5 people, 5 to 7. 7 starts to be a pretty large board actually. So that would depend on and composed of. Sometimes obviously the founder is often there, and typically is one of the shareholder and founder is there, and I think it's important that he or she is on the board. You may have 1 or 2 shareholder representatives, but as well it's important to have, to me at least, kind of not one but a couple of independent or outside board members, kind of not directly shareholders reps. And these directors or independent directors would ensure kind of the management of conflicts between and help the arbitration if there are any tension. They would help actually bringing some really business insights, practical insights. So for instance, we've been working with one company in your sector where the point is to they have finished a second round of finance. One of the shareholders kind of was rethinking of strengthening the board, and where they're really thinking of strengthening the board, they looked, and we looked with them at the strategy of the company and where the company should be within kind of 2 to 3 years, and what would be the main challenges to achieve that strategy, and what kind of qualities would be required to add as a sounding board and be able to add to discussions and advice to the CEO around these main issues. So one of the issues was very much around the logistics, another was very much around the management of the client relationship and the cross-selling that was around that. So that these one of the key competencies that was identified is someone who had the experience of really managing a company in a business expansion. So with the definition really of the processes, the having the controls in place, which is the part that we're gonna see just after. So having someone who had that kind of experience, hands-on experience, rather than a more passive that would be brought sometimes by the investors, who, on the contrary, the investors brought the overview of the sector and the trends and the practices, and that was another expectations that was from the board. So how I would staff it is around really the strategic considerations, and have people who can all bring a different piece. And why 2 independent rather than just one is simply because you don't always turn to the same person. So, you know, it's not only one person who say words. Sometimes it can be the 2 together, and that has more weight, and they can alternate in terms of the challenge. So it's not always you turn towards the independent and try to see. So it puts him or her in a better position as well to continue the challenging discussions. In any case, the way, and here that's why I mentioned the challenging discussions, is that it should always be taken into account as a positive challenge. That helps the management to open the eyes, or the board members or shareholders to open the eyes or look at things a bit differently. So that's what you have under B, the kind of decision making, and investors now would look at a number of kind of having an executive committee that would be formalized, for instance, and having a board that starts to be formalized with a clear remit that discusses strategy, financing, staffing, HR at that stage. We can move on, Patrick. So that's in more details the stage 2 to 3, where dimensions around succession planning. So we mentioned that it's an important mitigator. So getting the team as it grows. I mentioned that already. It's the management of decision making. So more, as I mentioned, more kind of collective aspects, and having as well HR to be a kind of a core function that helps to attract and retain or simply develop your colleagues as the company develops. so that the importance of HR planning and not just a payroll, that's fundamental, and have a board that is functioning, or at least have advisors that can help providing a sounding board to the management. These are often aspects that will be looked. I mean, that's part of it that a number of DFIs look at this stage. Patrick, moving on. So here I can kind of, I think we can pass over that the same companies and what was done, but here I think I'm more interested in having, from what we discussed, what would be the most difficult for you to implement, Patrick?
Sure. So launching again, as before, kind of which of these do you feel is the most challenging for your company? Setting up an executive committee, setting up a formal advisory board, developing a succession planning framework for senior management, making the HR function a truly integrated kind of strategic partner of the strategic management team, expanding the job descriptions for each position in the senior management into a detailed TOR, reviewing the qualities and qualifications of current staff, designing an incentive system to attract higher caliber talent, or taking care of hygiene factors such as an attractive work environment or a strong compensation and benefits package to retain your existing staff. And I can see around half of you have already responded, which is great. Most of you now, fantastic. I'll give sort of 10 or so more seconds. See if anyone else wants to respond. Great. So again, a real spread, I would say, on answers, but the most commonly cited being setting up a formal advisory board, and then really everything else getting 1 or 2 responses, which is interesting. I think that different people chose really different things. I'd love to know the reasons of why setting up a formal advisory board might be the hardest. Is that maybe finding the people, finding the the right skills and mix of experience? Kind of a networking issue or something else, but really interesting to see such a spread of answers.
Yeah, that's indeed interesting to see. I don't know if anyone wants to say something about some changes made here, or we move on to the. Okay, let's move on to the next one, which relates to the controls. So here on the control side, in a sense, on the stage 2, you start to identify some of your key risks and have some controls on your cash management, whistleblowing mechanism. It's hard to be looked at. I've seen that it's just, for instance, a simple mailbox where employees can provide complaints, for instance, but that's in a sense a channel where complaints can be escalated. But essentially on stage 3, it's to start one, which is important, and when investors really look at is how professional the CFO is. So that's consider the function of a CFO. It's really core 1. Then independent audit function, whether you have an internal auditor or not, that's another aspect. It's often not there, but you may outsource it for some key audits potentially, or think of it at least, and ensure that you have a view of some of your important controls and where the controls need to be checked. So that's something you investors sometimes look at, and the clarity of reporting lines obviously are important. On the stage number 4, then you really have an internal control system that is expected to be sound, with really an internal audit function that then reports to a board committee. And often that board committee is the audit committee that looks at the accounts and the clarity of the accounts, but as well as the strength of the internal controls of the company. And you would have as well the external auditors that starts to have to be recognized. So it's not a no-name, but not necessarily Big Four either, huh? but a company that has been recognized in the country. That's essentially what is expected under under that. And if we go more into details, on the stage 2 between the stage 3, it's really kind of to have a professional CFO that helps to work on the working capital and cash flow management. To have on the internal controls, really, it goes with the formalities of the processes, the mapping of them, and have actually persons really accountable for their right functioning. You may have as well kind of IT issues and how they've been managed. And here, actually, you may have audits that are run on their effectiveness from time to time. It's important. Then the conduct, obviously, is an important one. And investor starts to indeed expect someone who can, again, not necessarily full-time, but perform the role of an internal auditor, which is basically checking whether the internal controls that are set are functioning as expected. Patrick, we can move on to the poll.
Thanks. So same again, you're getting all quite experienced with this at this stage. So which of these 8 this time criteria do you think would be the most challenging? So creating policies to monitor and mitigate strategic and operational risks, defining the authority and limits of business units and divisions, hiring, as David mentioned, a professional CFO, developing a formal IT strategy, conducting an independent IT audit, developing a formal code of ethics and business conduct, establishing an independent audit function, and ensuring independent internal audit has the maximum possible independence within your company. Not to prejudice things, but I would imagine some of these would be quite tricky, would be quite demanding as requirements. And that's great. We've already got most of you responding. I'm going to cut this a little bit short just because I'm aware that we're pressed a little bit for time, and especially as most of you have responded. So once again, a real, again, a proper mix, but the most common ones being these kind of formal policies and procedures, defining the authority and limits, developing an IT strategy, which I would have suspected would be a tricky one, and establishing an independent audit, internal audit function, again, which I would have expected to be quite a tricky one. And fewer people saying that developing a code of ethics or hiring a professional CFO, none of you said that was a challenge, which I think is interesting.
Yeah, no, that's interesting results, and that's we'll see how to develop some in practice next week. Moving next on the transparency and disclosures. So basically, on stage 2, you have more ability to reconcile some of your banking accounts, and you have an agreement with some of the shareholders as what they would receive as information. Kind of develop the public profile. Actually, it's more about simply having a web page that is up to date and that provides the basic information on your company, who is running the company. That may seem really basic, but having discussed with a number of shareholders, really, one of the first things they look at is at your website, and if they see that the website is not up to date, is not really functioning, it gives them an impression that the company is a bit like that. So do not neglect that dimension. On the stage 3, well, it's really more to ensure that hence the importance of the CFO, because then that helps you to have financial statements that are in line with I don't know, the UADA standards or the accounting standards in your country. You may have as well few non-financial information that has been publicly disclosed. I will encourage you actually to disclose the profile and the competencies of both the management team and the board as well. That's often an asset, and provide a kind of some basic information on some performance to you. And in terms of business expansion, then really it's the financial reporting that in line with in financial statement that are audited by a recognized firm, and we've really measured on the quarterly performance that are reported to shareholders. If we move next and focus on these two, on financial disclosures, that's really preparing the financial statements against the national standards, and on the non-financial disclosures, It's very much kind of two aspects. One is the internal one, so basically what the board should be receiving. So really think of what the board needs to receive as information to control the performance, obviously, but as well to support. The other aspect is on the transparency, defining some key non-financial information, and really having your website that provides this. And one of the key policy, for instance, is your code of ethics and conduct that a number of investors do look at. If we go to the next poll, Patrick, and
yes, and slightly fewer options this time, which might make things a little bit easier. Which of these do you think is the most challenging for your company to meet? Preparing these financial statements in accordance with national standards, establishing a formal disclosure function, identifying the information to include in briefing papers for meetings with the advisory board, defining the key non-financial information disclosed publicly on the website, establishing a means to effectively communicate key decisions to all the staff, and also finally ensuring there is a regular communication of the code of ethics and business conduct policy. And I'm aware that some of you are having to drop off as we're running slightly over, so we'll give just a little bit more time. I can see most of you have responded, or those of you who are remaining. Maybe just 5 more seconds. That's great, thank you. And so again, we see a bit of a grouping towards the bottom 4. So identifying the information to including briefing papers, defining the key non-financial information to disclose publicly, establishing the means to communicate key decisions, and ensuring there's regular communication of the code of ethics and business conduct policy.
And the last bucket that we would look at in terms of governance relates to the owners and ownership and stakeholder management, actually, where on stage 2, it's important that people know how, for instance, there is a succession within the family. So how the succession in the family would affect the succession in the business. The other dimension relates to the simply organizing annual shareholder meetings when there are several shareholders, and on focusing more on the stage 3 on shareholders, it's here really the clarity between the roles of the founders, the family members, and the management. That is a very important point that many shareholders would really look at in understanding the clear distinction in terms of roles, and whether actually there are succession plans, and how does that affect family members. And in other words, whether family members have to make their proof to have some positions, or whether it's simply because they are family members that are accessing some of the positions. So that's an important aspect is looking at. And indeed, annual meetings with the shareholders where the key decisions, the dividends, allocations, and the funding plans have been discussed is something that is expected. On the stage 4, you would expect to have more regular communication and update with the shareholders, and as well really clear policies that would regulate how family members do interact with the business. And with that, we have kind of these 2 aspects more in details on the shareholder participations. I mean, it's really the here about organizing the shareholder meetings with the right information on time. That's something that one would look at when you have them, and ensuring that the information is properly distributed. And in terms of founder family role, it's really, again, here are a few questions about you to consider about kind of how you'd manage the family members that are wearing multiple hats, and whether these family members really understand the importance of clarifying that, and through policies and through setting clear career path for non-family members, because you want to retain the non-family members as well, and ensuring that there's no glass ceiling, because we've seen a number of companies that then when some family members might be nominated, some others say, okay, there is no role for me, and they may move away. The last poll.
So the final poll, after quite a few over the course of the session, is on, again, the same question, but this time related to the ownership. So which do you think is the hardest? Ensuring that shareholder meetings are well organized and function effectively, ensuring that documentation is professional and distributed promptly, making the shareholder meetings relevant and engaging, listening to the shareholders on voting issues, creating clear internal distinctions between the owners, the employees, and the non-employee or family members, ensuring that family members who have multiple roles or have multiple hats understand the proper modes of behavior in their roles, and finally identifying clear career paths for non-family executives or technical specialists within the firm. And I can see most of you have responded already, which is great. I'll just give maybe 10 more seconds for the final two. Oh, fantastic, all of you. And what's really interesting is all of you said the fifth one. I think that's the first time we've had a unanimous one in these 5 polls. So creating clear internal distinctions between owners, employees, and non-employees. And I think that's something we're really going to see in the case next week, this creating internal distinctions between particularly the owners and the founders and the employees of the company is a very tricky, or can be very tricky thing to manage.
Very good. So we kind of, as a wrap up, just obviously governance is important. We will share both the presentation with you and the IFC document that helps to monitor the different stages, and I think is a great compass to see and move on what is expected. It's kind of you'll find a number of aspects that we discussed here over there. I'm conscious we actually overrun time by 10 minutes now, but we shouldn't have made the introduction. That consumed too much time, but I think it helps as well the interaction. So, but here, happy to answer any question that you may have. We have time, and if you stayed until here, you may have at least 5 minutes maybe. So happy to spend them with you and answering questions that you may have. Ulrich, Russell, Sami, or Frank, or Segun, or Puck as well. Any current governance issues or questions that you are currently facing and that you would like to raise or discuss? No.
Thank you, David and Patrick. Frank here. Can you hear me?
Yes, Frank, please go ahead.
I would actually love to formalize an advisory board, and one of the key holdbacks for us has been let me call them the formal documents that give an advisory board leeway to participate in the activities of the company, and any remuneration thereof or compensations thereof. I would love to have a deep dive in that one-on-one if possible, or if it can be done here, well and good. Thank you.
So on the role, the role of advisory committees actually varies from company to company, really depending on what you are really looking for and what kind of value. Often it's a committee that meets twice a year and discusses important strategic aspects, but can be more active. Sometimes some of the advisory board members actually help to open doors and starts to be quite active as well. Which as well, the more active they are, the more potentially keen on being compensated they can be. I've seen advisory board members when meet once or twice, actually they are even not expecting to be paid, simply to have their costs covered when they meet. But if the business is interesting for them intellectually, they may do that just for in the importance of meeting with others and address important topics. When their time is a bit more consequent, then they may be asked to be compensated. Obviously, companies are not necessary, you don't have necessarily the funding for that. In terms of practice, sometimes I've seen as kind of a rule of thumb, which is you take how much the CEO is compensated per day, and and then you apply that. If you expect these persons to be kind of to prepare the meeting, a one-day meeting, to spend as well 1 day of prep, or then you can pay them accordingly, kind of the a pro rata of that if you have resources. And I've seen that as a kind of as a proxy for paying that as how much the management on average earn per day, and you apply that to your advisory board members. For some actually companies in the sectors I've seen, it goes, I will turn that into pounds, but from about £500 to £2,000 per meeting. Really, I've seen kind of variety of practices, again, depending on the resources of the company. And then if you have more, happy to take that. I think Frank.
Thank you, David. That was helpful. Thank you.
You're welcome, Frank. I don't know if anyone else has questions. If not, actually, well, two things. One, you can reach out to us, and Puck will follow up with an email with sharing both the link to the recording, sharing the presentation. The link to the recording will wait a little bit, but share the presentation and a few documents and prepare as well for next week. Puck, I'll let you conclude.
Yes, well, thanks a lot. I really enjoyed the session. I hope it was interesting for everyone, at least it was for me, and it's great to see we still have some people on board even after time. I think we could have discussed many more, so it's good we have a second session at least next week to discuss some outstanding questions, discussion points, and I'm really looking forward to that. And indeed, as David said, you can always reach out to me or Rowan to ask any questions to GOGLA, and as well to some of the Nestor team. And I will share the slides with you shortly, and the recordings will follow as well. So stay tuned on that, and I hope to see you next week again.
Likewise, same time, same link, and hopefully the same audience. Thanks a lot.
Thanks, everyone.
My best wishes of success for you all, and speak soon. Thank you. And thank you, Puck, for organizing all of you.
Thank you.
Bye, everyone.
Bye. Good rest of the day.
Thank you.